Hello and welcome to Close of Business. I'm David Chau. Australian shoppers are expected to splurge almost $7 billion in this year's Black Friday and pre-Christmas sales, with much of that spending on credit. But financial counsellors are warning this shopping binge could lead to a major financial hangover for many people, as David Taylor reports.
More shoppers are splurging heading into Christmas.
I might. Yes.
Do you have a budget?
No. There's no point, because if I did, I'd just blow it.
How much do you plan on spending?
Probably about...
$1 or $2 maybe?
Yeah.
Black Friday, a global shopping phenomenon, kicks off annually in late November, luring bargain hunters in with the promise of major discounts across almost every retail category. But shoppers are still blowing their budgets.
What we've actually seen is in the last couple of months, the level of balances that are accruing interest, people are being charged interest on, has actually increased in the last couple of months for the first time in quite a while.
In September, Australians had $18.4 billion of debt that was now starting to accrue interest on their card, a 4-year high. At the same time, applications for buy now, pay later credit services has surged 43%. Financial counsellor David Chau says calls to the National Debt Helpline about buy now, pay later debts are continuing to increase.
This year so far, we're over 7% more buy now, pay later issues have come through than in previous years, and we still have another 6 weeks of reporting to go.
Money.com's Sean Callery says buy now, pay later services are increasingly appearing more like traditional lines of credit.
What we've actually seen is some of the buy now, pay later providers is actually offering products that look a lot more like a credit card. So the two sectors have kind of, blended together somewhat.
And David Chau says the lure of credit is entangling more Australians in debt spirals.
What happens is that people try and correct the situation themselves by getting more debt, and then people are needing to get even more debt to service repaying the debt they already have.
Economists say this debt spiral usually rears its ugly head in February, when shoppers are forced to foot the bill for a Christmas spending splurge and inevitably cop a few extra expenses. The concern is that households are heading into this danger zone with more debt than usual.
It's really ticked up and that's before the spending spree. So while we've seen a lot of confidence about the outlook, from an economic fundamentals perspective, there's some worrying signs.
I'm cautious, yeah.
Why?
Because I guess I grew up with a frugal sort of family and we didn't have a lot of money.
The Reserve Bank will be watching consumer spending too, as the debt binge also puts pressure on inflation.
While the season's spending is picking up, so are prices. Hopes of a New Year's rate cut are all but dashed, with inflation climbing to 3.8% in the year to October. This unwelcome news has led to some economists predicting the next rate move from the RBA could be up. Samuel Yang reports.
It's the busy lunchtime rush at this Yamcha restaurant. For diners feeling the cost of living squeeze, eating out is now a luxury.
We can't afford to come very often because it's so expensive. It's just like occasional because I've got a colleague, who's going away, like farewell, Yeah, once in a blue moon, maybe.
I'm fortunate. I've worked for 45 years, so I can afford to come to lunch. But a lot of people obviously can't anymore.
The restaurant itself is also battling rising costs. Manager Jaden Ang says higher wages, produce and electricity bills are eating into profit margins.
Inflation definitely been a real challenge for us. As a restaurant, we open like 10 to 12 hours a day. In the fridge, we can't turn off the power as we store a lot of food in the freezer.
Annual inflation accelerated in October, up from 3.6% in September to 3.8%. Electricity jumped 37.1% as government rebates continued to wind down. Rents rose 4.2%, while building costs went up. Food was also a big contributor, driven by beef, lamb and seafood. The Reserve Bank's preferred measure of underlying inflation is now above its target band. This economist says although the new monthly inflation indicator is volatile, it shows cost of living is still a problem for many households.
It's better than where it was 2 years ago, where we had inflation well above 5% year on year. But clearly we still have quite elevated price growth in some categories, and particularly around services prices and for essential items as well.
This is the worst possible news for struggling mortgage holders, who can now kiss goodbye to any rate cut.
The through-the-year number was higher than we'd like it to be, but driven partly by temporary factors like the removal of state energy rebates.
The Treasurer wouldn't rule out bringing back the subsidies.
We'll take a decision about electricity rebates in the context of finalising that mid-year budget update.
A December rate cut is now firmly off the table, but the Reserve Bank will be watching closely how the labour market and inflation evolve in the coming months before making a move in February.
We at AMP still think that there is the chance of a rate cut next year, but we really need to see the inflation figures slow. Our view is that the inflation data will start to slow as we get into the second half of next year. But of course, given today's figures, the risk is that inflation is still just too high in Australia, and we need to wait a bit longer for it to settle.
In the meantime, businesses like this one have to make tough decisions.
Realistically, we can't absorb everything, so we make some adjustment on raising the price on some high-cost food.
A balancing act more businesses may have to face in the new year.
This surprise inflation spike could also present a tough balancing act for the Reserve Bank. While the odds of a rate hike next year have certainly risen, AMP's Chief Economist Shane Oliver believes there's still a chance interest rates might come down. Hi there, Shane. Markets are now saying there's a real chance of a rate increase in just over a year. But why do you feel there might be more rate relief ahead?
Well, I must admit I've lost a bit of confidence here, given those inflation numbers. But by the same token, we've got to allow that new inflation index is new. It's the first full monthly CPI index, and that's going to be quite volatile. Secondly, a lot of the pickup in inflation that we've seen has actually come from administered prices, index prices, as opposed to market sector prices. So it's not due to free market forces, it's partly due to government influence driving inflation up. Thirdly, economic data runs hot and cold. We've gone through soft patches, which got the Reserve Bank really optimistic about inflation coming under control and more rate cuts, and now we bounce back the other way. So it's quite conceivable we will go through a softer patch in terms of the economic data. And finally, I would just point out that monetary policy is still relatively tight. The Reserve Bank admits that it might just be a little bit tight, but that's not the sort of environment we'd think about actually having to raise interest rates. So our feeling is there's still some possibility that they could cut rates next year, but it would require a clear run of lower inflation numbers back below target and also higher unemployment. But either way, I do think it's too early to be talking about rate hikes next year. I think that's more of a story for 2027.
So Shane, the last thing many borrowers want to see is their mortgage repayments go up again. So what do you think it'll take for the RBA to do a complete 180 and go back to lifting rates?
Look, I think to see higher rates, you'd have to see an ongoing run of higher inflation, not the monthly numbers necessarily, but the Reserve Bank will still focus on the quarterly inflation numbers. So if the December quarter numbers that come out at the end of January are on the high side, we get the same thing maybe in the March quarter numbers, and unemployment remains low and the economy picks up faster than expected, then yes, we could see the Reserve Bank actually be starting to raise rates by the middle of next year or later next year. But we think that's all a little bit unlikely. It would be very unusual to have to start raising rates this quickly in an economic recovery, because the economic recovery is only just starting to get underway.
So we've seen central banks across the world almost get inflation under control. So why is this last mile of the inflation fight so hard to overcome?
It's a bit unclear as to why this last mile in terms of getting inflation down has become so difficult. Maybe it's because we've gone into a somewhat more inflation-prone world than the one we had pre-COVID. We know there's less competition internationally because of protectionist measures, in particularly Donald Trump's tariffs in the US. We know that labour markets perhaps a little bit tighter than they used to be, so that could also be a factor. Maybe also in Australia, at least, government-related inflation is a higher factor, certainly than it was pre-COVID. So there's a bunch of factors in all of this, and of course the situation is not entirely unique to Australia. Other countries have also seen inflation stall out at around 3%, or in some cases a little bit higher.
And not only has inflation been too high lately, but unemployment is also on the rise, which sounds like a tricky situation for the RBA. So Shane, if you were sitting on the RBA board, how would you deal with this dilemma?
Well, I think the best way to deal with this dilemma at present is to sit tight. The Reserve Bank is probably doing the right thing. We do have these conflicting indicators. There has been a bit of a rising trend in unemployment. Some of the forward-looking indicators of employment have slowed a little bit. Job vacancies and so on are a bit cooler. On the flip side, you've got higher inflation. Given the uncertainty around all of this, the best thing to do is sit tight for the time being.
Now, interest rates have also been a hot topic for the US, especially for Donald Trump, who's openly trying to stack the board of the US Federal Reserve with loyalists. Does this raise red flags about Fed independence?
Look, I think the situation in the US certainly does raise red flags about Fed independence. Donald Trump is already starting to stack the board. He's put one of his loyalists on the board in the form of Stephen Mirren. He tried to get rid of Governor Lisa Cook in difficult circumstances, and that is being challenged in court. It's unclear as to whether he'll be successful on that front. And pretty soon he'll get an opportunity to replace Jerome Powell as chairperson at the Fed, because his term expires in May, and it looks like he's going to make an announcement fairly soon as to who he will nominate for that role. And it's quite conceivable that the person nominated will be someone who's actually very close to him. That in turn will raise concerns about Fed independence at a time when inflation is still relatively sticky at around 3% or just below. So I think these are big issues. In the short term, it may not be a major problem, because if the US labour market is cooling and the Fed had to cut anyway, the market will look through it. But longer term, it could become an issue, because we know that investors don't like out-of-control inflation. They will push up bond yields and force the Fed to ultimately about face and maybe hike rates again. So we are potentially coming into a potentially difficult situation on this front, and hopefully common sense prevails. I think the better option for Trump would be to appoint someone like Christopher Waller or Kevin Warsh, a current governor or former governor, and that would probably go down better with the markets rather than his preferred choice, which looks to be the head of the NEC, and that person is very close to him.
And just very quickly, Shane, do you think the US Fed will cut interest rates in December?
The US money market is allowing for something like 4 rate cuts, almost 4 rate cuts over the next year and a half in the US, whereas in Australia the money market's starting to factor in rate hikes. It's hard to see that the economic outlooks between the two countries are that dramatically different. Australia doesn't look that much better than the US. So I think things have gone a bit skew-if here. The US money market's perhaps a little bit too optimistic. The Australian money market's probably a little bit too pessimistic.
Shane, as always, thank you very much for your insights. Really appreciate it.
Thanks, David.
Australia's banking regulator has announced new rules to limit the number of risky mortgages to homeowners and investors. From early next year, only 20% of new home loans will be given to those who are borrowing more than 6 times their annual income. Here's Nassim Kadem with the details.
This mortgage broker has worked in the industry for 27 years. In recent months, he's seen an increase in people wanting to take on more debt than they can chew.
There's a bit of FOMO, the whole fear of missing out is creeping into the market at the moment. So people will kind of do whatever they need to do at the moment to get into the market so I don't miss out. Sometimes it's first home buyers, sometimes it's investors, sometimes it might just be like a family trying to upgrade.
To stop risky housing lending, the banking regulator APRA has set new limits. Under the changes from February next year, lenders can only sell 20% of new mortgages to buyers whose debt is 6 or more times their income. At present, it's sitting at 6% across all loans. That includes about 10% of investor loans and nearly 4% of owner-occupier debt.
These changes are coming in as a bit of a guardrail against what APRA sees as some higher risk type lending. It's not so much about where we are today, that share still remains quite low, but protecting ourselves against where we might get to in terms of systemic risk.
The limit excludes bridging loans for owner-occupiers and loans for the purchase or construction of new dwellings.
It's going to push people to new properties, new builds, new properties, which tend to be in the outer areas of all the capital cities, but maybe also, your small developments and things as well. So, because then they're suddenly exempt from those rules. The biggest impact is probably likely to be on investors in the market. Investors might already have maybe a car loan and maybe a home loan. So if they now want to add an investment property to the mix, they're going to start exceeding, those debt to income ratio caps.
This is not the first time APRA stepped in. It reined in lending just over a decade ago to crack down on risky loans in the wake of the financial crisis. But a second round of restrictions on interest-only mortgages a few years later was quickly reversed, considered too heavy-handed at the time.
This is a bit of a different change to what we saw in 2017. And the reason for that is those changes in 2017, which put a cap on interest-only lending, were actually quite binding. The share of loans that were interest only at the time was well above the cap that APRA introduced. That's not the case for this cap that's being introduced. We're actually well under the cap at the moment, so it's unlikely to have anything like the effect we saw in 2017.
APRA's latest lending restrictions follow data showing that investor borrowing has been increasing much faster than lending to owner-occupiers. In its October financial stability review, the RBA warned that investor loans may prove to be at greater risk of default in a severe downturn.
It may dampen momentum a little bit at the margins, given it will constrain some investor activity. That said, we're still expecting that we're going to continue to see home price growth next year, much as we have this year.
The latest handbrake to cool what many see as an overheating housing market.
Food delivery drivers have won a long-running battle for a better deal on pay and working conditions. In an historic agreement between Uber Eats, DoorDash and the Transport Workers Union, drivers will receive guaranteed minimum pay rates. Amelia Terzon has the story.
Uber Eats drivers are paid per order. And this doesn't include waiting for the deliveries.
I've had to wait half an hour sometimes for the food to be ready. Thank you.
Eric Ireland thinks that his average take-home rate is below the minimum wage.
And maybe you get $20, $22 before you pay for petrol.
Uber Eats, its competitor DoorDash and the Transport Workers Union have struck a deal to give drivers better pay and working conditions.
These workers will move to the minimum wage plus 25% for each and every hour that they work. That is significant.
For the workers, the fight's been 8 years in the making.
Without any super, you're sick, you gotta go to work. There's a hailstorm, there's a rain, you gotta go to work. You can't stop. You've worked 60 hours?
Now, finally, we are having a minimum standards.
The two companies, Uber Eats and DoorDash, obviously support their proposal. They say it gives workers assurances while still supporting the gig economy.
But it doesn't mean that these companies are going to cover the extra costs. Delivery fees might go up, or
restaurants and the platforms themselves may also have to contribute somewhat in order to make it still an attractive enough service.
Eric hopes that customers are willing to pay a little bit more for his time.
That will make it a lot more relaxing and less frustrating.
The deal still needs sign-off by the Fair Work Commission.
To the markets now. There was finally some respite for Australian shares, which snapped a 4-week losing streak. The ASX 200 and All Ords finished the week around 2.5% higher, but they've fallen 3% in November, making it the worst trading month since April, when President Trump announced his Liberation Day tariffs. For more analysis on the markets, let's bring in economic futurist Evan Lucas. Hey there, Evan.
Hello, David. How are you?
Good, thanks. Now, this week seems to be the best one we've seen in quite a while for the ASX. So why have people decided now is essentially the best time to buy the dip?
I think it's a US-led story, let's be honest, David, in terms of what it is. If you have a look, the US has just had a 4-day winning streak, despite the fact that it is closed for Thanksgiving for most of the latter half. It is around tech, and part of the reason the Australian market is up quite strongly this week is the tech sector, after having a pretty decent savaging over that month of November that you've alluded to. It is back in slightly in the better books. It is also then materials as well. So if you look at what's happened this week around materials, they've been the driver. Overall, though, I mean, again, I'd say, is it a buy the dip? Is it a day, a week doesn't make a market? I'd probably put all those cliches into the line here. There is still unease. 2026 still has some cloud around, particularly from an Australian-centric point of view. And then the other question that's coming is, are we starting to see the start of a Santa Claus rally? It has happened pretty much every year for the last 5, barring what happened in 2020 at the back end of that year. I think all of that is at play. From my perspective at the moment, it is positioning and thinking about what 2026 will be and where the growth is coming from, because it's been a tech story this year. Will that continue to be the story for 2026? And that's my bigger question for the thinking of where we are going forward.
So fears of a tech and AI bubble have led to a big November sell-off, but those fears seem to have seemingly vanished. After all, you said a Santa rally has already begun.
Yeah, so with that, that's the fascinating question. And you're right to point out the AI bubble was very much the present story at the start of this month. It's still, given that possibility, NVIDIA was the lead up. We got the results. They were incredible. The initial reaction was up, then it was down, and since that has actually taken off. But the point about the AI bubble is how you define what AI is. And why I put that into the context is the AI story for the last 2.5 years has been the infrastructure side. The development of the cost centers, the development of the infrastructure, the development of the overall inputs into it. 26, 7, 8 and beyond is going to be about the software and the actual usage of it, because that's the next part of it. And as Boston Consulting Group this week pointed out, that at the moment we're only at 5% usage of the software side. So there's a long way to go. So the overall bubble is probably more in the infrastructure side. Have we got to the peak? Is the infrastructure now there? That's the question that happened through the month and where we've got to at the end of the month. But overall, the AI story in terms of the full picture still has a bit to run if you listen to what most in this space are talking about in the next generation of it.
And just very quickly, Evan, what should we be looking out for in the week ahead?
Look, I think you can't go past the GDP figures that are about to come out with regards to where they sit, how Australia is going, what it will mean for the week after, which is not just the fact that we know the RBA is going to hold on the 9th of December. It will be around, how does 2026 translate? Are we actually still, bumbling along GDP-wise? Inflation is clearly higher than expected. Unemployment is still quite robust. With all that in mind, this week is just going to be a setup for next year. If they're all doing exactly what is forecasted, which is things are too high in some areas, okay in others, it's about the discussion for rate hikes, really, in 2026. That's why this week is going to be so important.
Evan, thanks for breaking it down for us.
Thanks, David.
The price of Bitcoin crashed 30% this month as investors headed for the exits. Donald Trump's threatened tariff hikes against Chinese goods got the ball rolling earlier this year. But the Bitcoin dam broke when ETFs hit the sell button. Still, a brief moment of market panic couldn't stop the Bitcoin faithful from spruiking their wares at a Sydney investment gathering. Here's David Taylor again.
It bills itself as the Southern Hemisphere's largest crypto and blockchain event, CryptoCon.
Magic luck! I'm running hot!
Bitcoin believers were out in force.
It's an exciting asset class, and it's got a lot of people kind of talking about it.
A lot of governments are obviously acquiring Bitcoin, and then you have your retailers that are kind of picking it up too.
The cryptocurrency hit an all-time high in October. But then sentiment was rocked when Donald Trump announced an extra 100% tariff on Chinese goods, creating anxiety in financial markets. The price of Bitcoin plunged and is now down roughly 30% since its peak.
Any asset class will go through different cycles, right? So what we are seeing is a period of consolidation at this point in time.
Concerns are swirling around a decline in so-called crypto whales, investors holding more than 1,000 Bitcoin, also selling out.
I suspect that what's behind it is a growing perception on the part of people who've previously bought Bitcoin that it has run way ahead of any plausible interpretation of its potential value, and particularly for those who've established positions in Bitcoin or other cryptocurrencies with borrowed money.
When the value of the asset purchased using borrowed money falls below a level the lender is comfortable with, the investor may be asked to stump up cash in what's known as a margin call, sometimes by selling the asset they've bought with the loan. Saul Leslake says billions of dollars have flowed out of Bitcoin exchange-traded funds, or ETFs, as margin calls grow.
Those outflows are increasing in size, and that's why the price has fallen so much over the last few weeks.
The price of Bitcoin climbed roughly 4% over the weekend. Analysts say after all the negative news, a hint from the US central bank that it might cut interest rates at its December meeting enticed investors to jump back in.
Obviously, the Trump administration will be putting considerable political pressure on the Fed to cut rates, but the Fed, so far at least, has maintained its independence, and it will do what it thinks best.
The key question is whether Bitcoin can scale new heights.
There's a lot of stigma around crypto. Fundamentally, this is this and that. There's a lot of noise around it, but you can see as behind me, there's a lot of good people and a lot of good companies behind.
Since Bitcoin doesn't return any income, it doesn't pay interest, it doesn't pay dividends, and it has no intrinsic value. If you don't believe it's going to keep going up, why hold it?
Go!
But for some, riding the wave is enough.
Don't give up! Never give up!
But risks remain ever present in this highly volatile market.
And that's all from Close of Business. For more on those stories, you can head to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern Daylight on the ABC News channel and after the late news on ABC TV. I'm David Chau. Thanks for tuning in.